Imagine looking at a thermostat in your living room, and it reads a perfectly comfortable 72 degrees.
Right. Sounds ideal.
Yeah, you think everything is totally fine right up until you walk into the kitchen and realize the pipes are completely frozen solid.
Oh, wow. Yeah, that's a problem.
Exactly. And, if you are only looking at the top line numbers in the market today, you are looking at that broken thermostat. You see an index sitting, within striking distance of its all-time high, but beneath the surface.
Yeah.
More than half the market is actively falling.
It's a huge divergence.
It really is. So welcome to this deep dive into today's Trading Desk Brief. Our mission today is to, decode this highly contradictory tape. We're looking at the exact numbers and the hidden pressure points that are really driving the action.
And before we pull apart the actual mechanics of this divergence, I do think we need to set the boundaries for this discussion.
Oh, for sure. Go ahead.
We are analyzing exact levels here. Structural data, institutional positioning, all sourced from major financial outlets. But to be abundantly clear, none of this is financial advice.
Right. Never.
Yeah, we are not recommending you buy or sell any security at all. We're just mapping out the architecture of risk in the current market, so you can understand where the structural traps and opportunities actually sit.
Which honestly brings us directly to what the desk is calling the breadth mirage. Because on the surface, the numbers look incredibly bullish.
They do, yeah.
We're tracking the S&P 500 through the SPY ETF, which closed the session right around 747. And the intraday high, it tagged 748 on the nose.
Just a hair away from the record.
Right. That puts the SPY roughly 2% away from absolute record territory. But, the headline hides this severe internal breakdown. The index itself gained about 0.75%, yet only 42% of the underlying stocks actually managed to close in the green.
Which is crazy, right? That is the defining structural anomaly of this tape right now. You had massive financial components trading incredibly soft today.
Yeah, the banks were heavy.
And you had healthcare heavyweights too, like Eli Lilly and Johnson & Johnson, basically acting as dead weight, just dragging down the average. We're looking at a scenario where nearly 60% of the broad market is losing value on a day the index is actually marching higher.
But let me challenge the idea that this is necessarily a mirage or, a trap. The S&P 500 is market cap weighted.
True.
So the biggest companies dictate the direction because, they generate the bulk of the earnings. If the giants are outperforming, isn't the index just doing exactly its job?
In theory, yes.
Why should we care if a regional bank or some mid-tier healthcare stock is lagging when the mega caps are just thriving?
Well, you're right that cap weighting is designed to let the winners run. That's how the math works. But the problem isn't the weighting itself. It's the vulnerability that this level of concentration creates.
Okay, unpack that a bit.
So when you have 60% of the market drifting lower, the index relies entirely on a shrinking handful of names to basically absorb every single dollar of passive inflows.
Ah, right, the passive indexing loop.
Exactly. It creates this feedback loop where money flows blindly into the largest stocks, completely regardless of valuation. If those specific leaders face a sudden headwind, there is zero underlying support to catch the index.
Because the rest of the market is already, quietly tapped out.
Right, they're already on the floor.
So we are looking at this massive, heavy train being pulled by a single engine. And right now, that engine is essentially just the semiconductor sector.
Pure and simple. And the data illustrating this divergence is historic. It really is. We are looking at the best first half outperformance for semiconductor chips versus the broader market on record.
Wow, on record.
Yes. The Philadelphia Semiconductor Index, the SOX, has surged a staggering 94% year to date.
94%. While the S&P 500 is up just about 9% over that same window. That's a massive gap.
It's unbelievable.
And when you look at the individual names driving that 94% figure, the scale of the capital flows is almost hard to process. Like Micron, ticker MU, is up more than 250% this year.
Yeah.
And there's another memory and storage player highlighted in the brief that has vaulted over 700%. The entire heat map for this trade is just concentrated in the SOXX ETF, right? The one that holds Broadcom, Intel, AMD, and Micron.
Yeah, that SOXX ETF is basically the structural pillar holding up the broader index. But, the steepness of that ascent brings us to the macroeconomic variables that are sort of operating in the background here.
The hidden pressure cookers.
Exactly. Because a narrow rally is one thing, but a narrow rally fueled by historic levels of leverage, that is something else entirely.
Right, the margin debt. The latest Fenner margin debt figures paint a really specific picture of how this rally is actually being funded.
Yeah, they do.
And for those tracking the data, margin debt just measures the capital investors are borrowing against their existing portfolios, to maximize their purchasing power. Currently, investors are borrowing against the money supply at the second highest level in recorded history.
Which is just sobering context. I mean, the only time margin debt has ever eclipsed this level relative to the money supply was at the absolute zenith of the dot-com bubble in 2000.
Yeah, which means we are dealing with a highly, highly levered system. But I do want to avoid the cliche of calling leverage rocket fuel.
Why is that?
Because institutional leverage works a bit differently today, especially with portfolio margining. It's more like structural tension. When funds borrow heavily to maximize their exposure to a handful of semiconductor stocks, they're assuming volatility is going to stay low.
Right. They need it to be calm.
But if the price suddenly drops, their prime brokers automatically demand more collateral. And if they don't have cash on hand, they have to liquidate positions.
And that forced liquidation is purely mechanical. It doesn't care about fundamentals. It simply sells what can be sold to satisfy the margin call.
Exactly.
But to truly understand the fragility of this market, you have to pair that domestic margin debt with what is happening in global currency markets right now, specifically the collapse of the Japanese yen.
Okay, yeah. It has cratered to its lowest level since 1986, which, sounds like a problem for Tokyo. But we are analyzing a U.S. equities brief here.
Right. Why do we care?
Exactly. A lot of people might wonder why a desk trading tech stocks in New York cares about a 1986 level currency extreme in Japan.
Well, it all comes down to the mechanics of the carry trade and really global liquidity. For years, massive institutional funds have utilized this very specific strategy. They borrow Japanese yen because the interest rates in Japan have been practically zero.
So it's basically free money to borrow.
Exactly. They take that cheap borrowed money, convert it to US dollars, and buy high-yielding global assets. Lately, that includes massive positions in US tech and semiconductor stocks.
So it's essentially an arbitrage on interest rates. But that trade only works if the yen stays weak or stable, right? If the yen suddenly surges in value, the cost of that borrowed money just skyrockets.
Precisely. If the yen appreciates sharply, whether that's through natural market dynamics or direct intervention by the Bank of Japan, those global funds suddenly find themselves underwater on the currency side of their trade.
And they have to cover that.
Yeah, and to cover those losses, they're forced to sell their dollar-denominated assets.
Right.
If their currency collapses too far, Japanese institutions are heavily incentivized to sell American assets and repatriate capital just to stabilize their own markets.
But wait. Haven't the markets already priced this in? I mean, we've known the yen was weakening for months, and the Bank of Japan has been telegraphing their discomfort. Surely institutional desks have hedged that intervention risk by now.
You would certainly think so. But the sheer size of the carry trade makes it almost impossible to fully hedge without eroding the very yield they are chasing in the first place.
Yeah, right. Hedges are expensive.
Exactly. And we saw this exact dynamic play out in the summer of 2024. A sudden, sharp intervention forced a rapid unwind, and U.S. risk assets dropped violently. It operates like a systemic tripwire.
So fundamentals get thrown out the window.
Totally. It doesn't matter how good a tech company's earnings are if a trillion-dollar currency unwind forces global funds to liquidate their portfolios simultaneously.
Okay, so we have this crazy convergence of extremes. Narrow market breadth, a total reliance on semiconductors, dot-com level margin debt, and a 1986 level yen. And according to the brief, all of this macro tension is currently pushing against one exact level on the charts.
Yeah, the SPY at 750.
That is the defining wall right now. We saw the SPY tag 748 today. And the mechanics of these big round numbers are fascinating because they aren't just psychological.
Right, there's actual flow there.
Yeah, 750 is a massive strike price for options contracts. Options dealers have to hedge their books as the price approaches that level, which actually creates a physical barrier in the market order flow.
That's the gamma effect at work. The closer the price gets to 750, the more dealers have to sell into the rally just to stay market neutral. So they're effectively capping the advance.
But if it breaks through?
Well, if the momentum is strong enough to break and hold above 750, those same dealers are forced to aggressively buy the underlying stock to rehedge. And that creates a rapid melt-up. It is a highly, highly binary setup.
And if the market fails to break that 750 wall, the desk has laid out the exact downside levels where the structural support sits.
Right. The immediate safety net is 743. That was the breakout level from yesterday's session, and it successfully acted as support throughout today's trading.
Okay, 743.
If the price closes below 743, it signals immediate exhaustion. Below that, the next shelf is 740, and the absolute line in the sand for the short-term trend is 732.
Which marks Monday's low, right?
Exactly.
And if 732 breaks, the broader narrative shifts entirely. That's when you start seeing those algorithmic sell triggers activate. And, the timing of this test at the 750 wall is complicated by a very dense calendar over the next 48 hours.
It really is a perfect storm of seasonality and macro catalysts. First off, we are stepping into July seasonality, which historically stands as the strongest month of the year for the S&P and the Dow.
Right. But we are also walking into a holiday week. U.S. markets are closed Friday for Independence Day, and the mechanics of a holiday week are crucial here.
Thinner liquidity.
Exactly. You have fewer institutions actively trading, which means the order books are shallower. When order books are thin, it takes significantly less volume to move the price, so a minor news event can trigger a disproportionately massive price swing.
And right into the middle of that thin liquidity, the newly installed Federal Reserve Chair is actually scheduled to speak at a major European central bank panel in Portugal.
Oh, wow. So the entire market will be parsing every single syllable for a read on inflation and interest rate policy.
Every word.
If there is even a slightly hawkish tone regarding inflation, bond yields and the dollar are going to react instantly. And given the leverage in the system, equities will just do passengers to whatever the bond market decides to do.
Exactly. A hawkish surprise into a low liquidity holiday week, while the index is literally pinned against heavy resistance at 750. That is the exact type of catalyst that can ignite that margin debt dynamic we discussed earlier.
Now, if the broader index is trapped under 750 and macro risks are rising, sophisticated capital doesn't just, sit in cash. It migrates.
Right. It looks for new homes.
Exactly. It looks for idiosyncratic, news-driven setups that are completely decoupled from the S&P 500 and the yen. Which brings us to the specific sector breakouts the desk is tracking today. Let's start with the space sector.
Yeah, space is seeing massive capital rotation right now because it's being driven by hard consolidation, not just macro speculation. Reuters just reported an $8 billion commercial satellite acquisition.
Which is huge, because when an $8 billion deal hits a sector, it forces a complete re-rating. Analysts suddenly have to recalculate the baseline valuations for every other company in that space, all based on the premium paid in that acquisition.
And the immediate beneficiary of that re-rating is Viasat, ticker VSD. Over just the last 2 trading sessions, VSC has surged 17%.
Wow, 17% in 2 days.
Yeah. When a sector experiences structural consolidation like that, the capital flows aggressively into the clearest surviving proxies.
Makes sense. And we are seeing a similar dynamic in the drone sector too, though. This one is being driven by fundamental earnings rather than mergers. AeroVironment, ticker AVAV, jumped 19% following a notably strong earnings report.
And that kind of fundamental strength often acts as a rising tide for the more speculative names in the same basket. For example, the brief notes that Unusual Machines, ticker USC, bounced 16% alongside it.
And there is actual revenue growth behind that move. UNC reported Q1 revenue up nearly 300%.
That's a serious number.
It is. But the desk is very specific about how to manage the risk on UMAC. The exact structural level to watch is 18.
Yeah, level 18 is the critical floor there. In these high beta, highly speculative names, you have to rely on strict technical boundaries. If UMAC holds above 18, the momentum thesis remains perfectly valid.
But if it loses it?
If it loses 18, the thesis is structurally broken, and frankly, the revenue numbers won't stop the algorithms from selling.
It's pure if-then logic. So moving to another policy-driven rotation, the polar sector is setting up for a massive shift right now. Reuters is reporting that the U.S. administration is drafting a formal ban on imported Chinese power inverters.
Right, and the policy is being framed around national grid security concerns, basically ensuring critical energy infrastructure isn't reliant on foreign technology.
And, setting any politics completely aside, the market mechanics here are very straightforward. An impartial look says a ban on cheap foreign competitors instantly hands pricing power and market share to domestic U.S. solar companies.
Completely. And the most efficient vehicle the desk is monitoring to track this policy shift is the TAN Solar ETF. It just provides broad exposure to the entire domestic supply chain.
And what's the level on that?
The critical level defining the uptrend for TAN is 56. As long as the ETF maintains support above 56, the market is effectively pricing in the upside of that impending policy shift.
Okay, so we've covered where the capital is flowing, but in a market where 60% of stocks are in the red, we also really have to monitor the rejections. The desk flagged a very specific setup in Tesla today.
Yes, Tesla has been riding a powerful momentum wave, but it just encountered heavy structural resistance. The stock was cleanly rejected at the upper boundary of its current rising channel, specifically in the 424 to 425 zone.
And channels are essentially the physical boundaries of a stock's current trend, right? By hitting 424, Tesla essentially slammed its head on the ceiling of its current momentum trajectory.
Right. And the read here is highly binary. If the stock continues to fail at that 424 to 425 barrier, the path of least resistance is a drift back toward the median of the channel, which sits all the way down around 400.
But if the volume steps up and it decisively clears 425, well, then it forces all the shorts who are betting on that ceiling to cover their positions, creating a brand new breakout. But, until then, the rejection is the dominant technical signal.
Exactly. And speaking of momentum triggers, the brief outlines 3 other critical continuation levels for highly volatile names. These are pure algorithmic pivot points.
Let's run through them real quick. For Fuel Cell Energy, ticker FCEL, the upside continuation level is 38. For Intel, ticker INTC, the upside continuation trigger is 142. And on the downside, UBR has a critical structural support at 72.
Right, and if UBR loses 72, the downside momentum just accelerates.
Yeah, exactly. But I want to spend our remaining time on what might be the most fascinating data point in this entire brief, because it highlights exactly how institutional whales navigate this kind of macro fragility.
Yep. You're referring to the options activity in GXO logistics.
Yes, I am. I mean, we aren't talking about technical support lines here. We are talking about millions of dollars in premium being deployed in a highly targeted manner. The desk picked up a single entity risking $2.2 million on a call spread in GXO, expiring in late August with a max payout of $3.4 million.
The mechanics of this trade are just brilliant. The trader is capitalizing on a technical formation known as a triple bottom.
Basically a super strong floor.
Exactly. GXO has tested the 46 level 3 distinct times over the past few months, and every single time, buyers have stepped in to defend it. So this whale is deploying $2.2 million on the thesis that 46 is an unbreakable floor and that it will bounce a 4th time before the end of the summer.
But what makes this so interesting isn't just the chart pattern. GXO is a logistics and warehousing farm. In a daily brief dominated by semiconductor euphoria, yen carry trade risks, and macro margin debt, why is a $2.2 million options trade on a logistics company the standout detail?
Because it represents the pursuit of uncorrelated alpha. GXO's price action currently has almost 0 correlation to the S&P 500.
That is the key right there, uncorrelated.
Exactly. When you have a hyper-concentrated market resting on a single sector and propped up by dot-com levels of leverage, the most dangerous place to be is in a crowded trade.
Yeah.
If the yen carry trade unwinds, or if the 750 wall triggers a cascade of margin calls in tech, GXO's valuation likely won't be materially impacted because its performance just isn't tethered to the semiconductor cycle.
Right. So seeing a sophisticated player park $2.2 million in an uncorrelated asset tells you that, well, smart money is actively building lifeboats that aren't attached to the broader index.
They're finding places to hide that won't get dragged down if the 750 wall holds and the market just rolls over.
So synthesizing everything we've extracted from today's brief, we're observing a headline index that is virtually at an all-time high, but completely masking a severe breadth deterioration where the majority of stocks are actually losing ground.
A total mirage.
Right. The entire rally is overwhelmingly dependent on historic surge in semiconductors. And beneath that, you have investors utilizing portfolio margin at levels not seen since 2000, while the Japanese yen sits at 1986 lows, presenting this huge systemic risk to global liquidity.
So it's a powder keg.
It really is. And all of this mechanical tension converges at a single, heavily defended strike price, SPY 750.
And as we wrap up, let me firmly reiterate our baseline rule. None of the levels or tickers discussed today constitute a recommendation to buy or sell.
Yep, strictly informational.
We are just sharing these exact figures, the 750 wall, the 743 support, UMRC at 18, and GXO at 46. So you can clearly identify where the structural risk resides and calibrate your own exposure accordingly.
Which brings us to a final variable for you to consider, something the market hasn't fully digested yet. We've talked about the internal fragility of the AI and semiconductor rally, and we've mapped out the external threat of a sudden yen carry trade unwind. But what happens if those two forces collide simultaneously?
That's the scary part.
Right. Imagine a scenario where the semiconductor space faces a sudden, sweeping regulatory headwind regarding AI data usage on the exact same week the Bank of Japan finally steps in to violently defend the yen. If the single engine pulling the market stalls just as global liquidity is forcefully repatriated to Tokyo, the resulting margin cascade wouldn't just break the 750 wall. It would fundamentally rewrite the mechanics of this market. So keep a close watch on the data to see which domino falls first. Thanks for joining us on this deep dive.